All right, again, hello everyone. My name is Mark Sproul with Money Show. We have a fantastic panel featuring some of today's top gold experts. While stock markets are tumbling and economies are slowing, gold and gold stocks are soaring. Our panelists will discuss what lies ahead and how you can find profits and safety no matter what happens. Now, just a couple of things to keep in mind to get the best experience out of the webcast. You'll want to turn off your instant messaging, Skype, quote news systems, anything that will take away from the GoToWebinar platform. If the audio is continuously poor, you can always call in on the telephone, listen while watching the slides live online. Click the Use Telephone button where a phone number will appear for you to dial in. It's long distance, so please keep that in mind. We might have time for questions, time permitting, at the end of the session, so feel free to type those in the questions field as we go. This session will be available on demand for you. Just simply log on to moneyshow.com. We will have a link out to you as well to the session. So Brian, you have controls here. I do see your screen.
Okay, good.
So everyone, we are delighted to welcome our moderator for today's panel, Brian London, president of Jefferson Financial, executive editor of Gold Newsletter and host of the famed New Orleans Investment Conference. Our panelists are Peter Schiff, CEO and Chief Global Strategist of Euro-Pacific Capital, Brent Cook, a renowned exploration analyst and geologist and the author of Exploration Insights, and Mike Larson, editor of Safe Money Report newsletter, Weiss Research's first and oldest publication. All right, Brent, it's all you.
Glad to be here, Mark. And as you can hear, everyone, this is kind of a quick impromptu webinar we decided to call, featuring the speakers, most of the speakers, on this upcoming Money, Metals, and Mining cruise to Alaska coming this July. And one of the reasons why we wanted to have this event right now is precisely because of the big run in gold that we've seen so far this year. And it's similar to a run that we've had over the last couple of years, and in fact most years since the turn of the century. So the question facing investors right now is this real? Will it last? Is this the turn of the market and the rise off of that long bottom, or is it another fake out? And really over the long term, does that matter? But we decided to bring together some of the, or most of the speakers at this cruise to address that issue precisely today. As you can see in your screens, the cruise will be happening in July, the 10th to the 17th, on the Crystal Serenity. And our speakers today will be Brent Cook, Mike Larson, myself, and Peter Schiff. Peter actually will be making a special presentation at the end of that cruise at a one-day symposium in Vancouver. So that's another special benefit of attending this cruise. So without further delay, let me try and set the stage, as it were, a bit.
Hey Brian, I'm currently not seeing your slides.
Oh, okay. I'm sorry. Let me see if I can. I have. Okay. Now you should. Can you see them now?
Yep. Looks good.
Great. Great. So. Real quick, the itinerary for that cruise will be 7 days, hitting all the major locations in Alaska, starting in Anchorage and ending in Vancouver. I'm very excited about this. This will be the fourth such cruise I've done, and I think it's going to be really the most exciting, not only for the locale, but for the stage we are at in the markets. I think anyone who comes on this cruise and can talk to our speakers firsthand and mingle with them and get their views in a much more relaxed setting are really going to be well rewarded over the next coming months and years. So let's set the stage here. As you can see, gold bottomed in late December and really took off right at the beginning of the year, and is beating every other asset class out there. Now, this is something that we fully expected. I think really everybody on this seminar right now was on this webinar was predicting something like this. I have to say I didn't really expect it to be so dramatic so early, right out of the gate with the new year, but it has been. And what we've seen is that there's been a bit of a delay before the miners responded to this, almost literally 19 days, but you can see what's happened since then with the mining stocks. They've served their role well. They've highly leveraged the moves in gold. If this move in gold continues, that leverage will continue, and there are a lot more gains to come. If you look at this, though, with this chart that I brought up, we've seen these kinds of moves before. If you look early in 2014, we had a move from 11.95 in gold to 13.85, a 16% rise in the early year. If you look last year, we had that rise from 11.42 to 12.95, still higher than we are right now, and that was just in the month of January. So a lot of people are getting really excited about this move, but you can see we've had these moves before, and they came at higher levels and ultimately ended up at higher levels. For my part, I'm a bit skeptical on this move until we can do one or two things, either get into the April time frame, somewhere around here, where we have a longer duration than we have the last couple of times this has happened, or if we beat 13.85 and we get higher than we did in 2014, then I think we can start looking at this as legitimately, very likely, the next bull run in gold and the ending of the bottoming process. But for me, I'm still skeptical for right now because we've just been burnt too many times before. However, there are some things different with this move. We see this stochastic here where we're still rising, indicating we have a bit more to go. We've had a nice breakout here. Again, though, until we get up into around 13.85, in my view, I think we still have to be a bit cautious. And here again, we see on another technical indicator with exponential moving averages that we have had a major breakout. So from a technical standpoint, it looks really good. Again, in my view, I think we have some things to prove, but from a fundamental standpoint, there are a number of factors that are really moving in gold's favor. And if not this time, then over the long term, we will have that breakout, and we will have a renewed bull market in gold. Now, with that said, I'd like to move over to some charts that Mike Larson has provided and some views that he might have. Mike, do you have some comments on this?
Yeah, I sure do. Thank you, Brian, and appreciate everybody coming to this webinar. What has me so excited about the move in gold and how it's happening now is that it's coming at a very important turn in the credit cycle overall and the economic cycle. I'm a big believer in following what the bond markets and the credit markets are telling us, and what I see happening is a move in gold that corresponds with much weaker economic data, both overseas and here in the U.S. And it's also happening at the same time as the cost of borrowing for high-risk companies and even for higher-grade companies is going up. And the fact that you're seeing all of these things at the same time is really, to me, a signal that some of the central bank control or illusion of control that we've had out there for the last several years is breaking down. I think that's one of the reasons gold and gold stocks are becoming attractive again, is that it's almost like a disaster or monetary disaster insurance. Investors are buying gold as protection from central bankers who are increasingly losing control of the markets. And just to briefly touch on a few of the slides and charts I have here, this is happening again at a time where the real economy, especially the manufacturing economy, is getting much weaker. We obviously know that that's been happening in China, in South America, in parts of Europe as well. But this chart just shows the ISM manufacturing index for here in the U.S. And you can see that we fell to a reading of 48 in December, and we're basically unchanged in January. And as this chart illustrates, these are lows that we haven't seen going all the way back to June 2009, which is the tail end of the last recession, the Great Recession. So clearly the manufacturing sector is in a state of tumult here in the U.S. and is really having problems, reflecting some of what's going on overseas, as well as just the weakness in key sectors like energy and commodities here in the U.S. So I think that's important.
You know, Mike, just to add a bit to what you're saying, you know, the industrial production index fell in January and it fell in December. And it fell on a quarterly basis for the fourth quarter and on an annual basis for 2015. That has never happened since World War II outside of a recession. So that's been pointed to by a number of sources, myself included in gold newsletter, as a real indicator that we might be in a recession as we speak.
Yeah, absolutely, absolutely. And some of the regional manufacturing indices, we just got Chicago today, and that was very ugly. Dallas, some of the other ones in the Midwest have been pretty disappointing. And again, when it comes with some of these other signals from the credit market, it really shows why gold is becoming much more attractive, because it's happening at this point in the economic cycle where people are looking for something that can preserve and build their wealth out there.
And here we are with your chart showing the tightening credit market as we speak.
Yeah, exactly. This chart here shows the Federal Reserve goes out there every quarter and talks to banks and asks them, okay, are you seeing more or less demand for loans of various types, home mortgages, credit cards, commercial loans, and so on. And they also go out there and ask, what are you doing with your standards? Are you making it less expensive to get a mortgage or a commercial loan? Are you charging higher interest rates? Do you require a higher or lower credit score, and so on? So they do all this surveying, and then they produce data showing are lenders on net being tighter or looser with lending standards. And what you can see here, this chart goes all the way back to the mid-1990s. You can see that we've had a couple of big cycles of tight money and easy money. The net percentage of lenders tightening standards on commercial, industrial loans shot up around the turn of the century, because that's when we had the dot-com bust and the associated recession. Then obviously in the mid-2000s, we ended up with much easier lending standards, and that helped give us a massive housing bubble. And then as that bubble popped, we had another surge in tightening of lending standards, banks getting much stingier with money. After that Great Recession period, once again, we had a period of very easy money, and in this case, it lasted much longer than the last cycle. And so that's why we've seen a lot of these bubbles and booms in various parts of the economy and the markets that are dependent on cheap and easy credit. That process is over. The losses that are happening in the energy sector, in many other sectors of the economy, and leveraged loans and so on, is making banks start to tighten again. But as you can see from the far right, we're at the highest level of tightening since the tail end of 2009. But we're still climbing, and we still have a lot of room to run, in my opinion, till we get close to the levels that we saw in the last two recessions. So again, that turn of the credit cycle, when it corresponds with the surge in gold, tends to tell me that investors are realizing the economic cycle's changed here, and we need, the central bankers have sort of lost the ability to manipulate markets that they've had for the last several years, and that's why gold is a great place to go.
Let's take a look at your next chart, which I found is just as interesting.
Sure. This chart here shows the past couple of major negative turns in the credit cycle and the positive turns that followed. What you're looking at here is a chart that shows the spread or difference in yield between junk bonds and treasury bonds. The wider that spread, the more investors are selling junk bonds because they're afraid of defaults. And then the opposite's true as well. The narrower that spread gets, the more confident investors are in owning risky bonds, and that helps to improve the economy because money is easy and easy for companies to get their hands on. What you saw beginning in the late 1990s, as the dot-com boom began to fizzle out, you saw the spread widen substantially up to around 10-11% between 2000 and 2003. Then spreads peaked as the economy began to turn and the credit cycle began to turn, and you had this multi-year period where money was getting cheaper and cheaper, and riskier companies had no trouble borrowing. That process had a turn for the worse in 2007, 2008 as the housing bubble began to pop, and we had that huge surge. I mean, junk bond yields on average were up in the 20% range, which was the highest we've ever seen in the history of the junk bond market. That's that big peak you see there in 2009, and the shaded area being a recession back then. Then, again, the period of very easy money that has now turned for the worse for the third time here. So I think that multiple indicators are suggesting, again, that the economic cycle, the credit cycle has really turned, and that requires a whole new set of investment strategies and a whole different approach to the markets than you had when money was easy and easy to get, and companies, even with the worst credit ratings, could borrow very cheaply.
Yeah, Mike, looking at this chart, a couple of things hit me. One is that obviously recessions are always called in arrears. You know, they look back as much as a year or two and say, oh, there was a recession back then. And in fact, as these credit spreads begin to blow out, then you realize that you were actually in a recession at the time that they started to rise, started to spread. The other thing is, if you look at where they peaked in 2009, over the next 3 years, the gold price more than doubled.
Yeah, absolutely, absolutely. I mean, these are leading indicators from the bond market, from the credit markets, telling you, you know, that even if the economic data looks decent or is not terrible yet, if banks are tightening lending standards, if the bond market is tightening lending standards, and credit gets harder for companies, both high-risk companies and those with lower risk levels, that's going to be a problem for the economy, and that definitely is a signal for changes you need to make in your investment strategies.
Peter, I think you actually addressed, we were on a panel at another conference actually this weekend together, and I believe you even addressed this during one of your remarks, didn't you?
Address what?
The junk bond spreads blowing out as they are now?
Oh yeah, I mean that's just one point of many that I made, but
Right.
certainly that's just an indicator of where we are in the cycle. But you know, in answer to your earlier question about whether this is just another head fake, whether this is just another opportunity to get short, like the past several rallies that we've had over the course of this, you know, correction in what's been a longer-term bull market, but we've been in a correction or bear market, whatever you want to call it, for the past 3 years. And the reason that I think that the odds are very high right now that this really is a turn, that this is not another shorting opportunity. If anything, it's a trap for the shorts because, you know, we finished last year with probably a record short interest in physical gold and gold mining stocks. All the major players were short gold at the end of last year. And, of course, you've already shown the charts of what's happened this time around. And the reason everybody was so short is because the Fed finally raised interest rates in December, which was something that the markets were anticipating for years. And the idea was that, well, this is going to be terrible for gold. This is going to be the final nail in the coffin because when the Fed raises rates, that's going to crush gold, and the Fed's going to keep raising rates, and we have this great recovery, and you know this is it for gold. And the Fed had been talking about raising rates for a long time, but they didn't get around to doing it until December. And this was supposedly the all clear, yes, gold's going to get crushed, everybody got short. And what I was saying for the last several years was that this whole idea that the U.S. was enjoying a real recovery and the Fed could raise rates was pure nonsense. That in fact the U.S. economy was in worse shape than it was in 2008. And everything the Federal Reserve did just exacerbated the problems. It didn't cure them, except that cheap money was masking it. It was creating an illusion, and people were focused on the stock market, and they weren't focused on what was going on beneath the surface of the U.S. economy, or they were distracted by headline unemployment numbers or GDP growth. And I said, just look beneath the surface. It's a totally different story. And what I always said was that if the Fed ever did raise rates, it would have to quickly reverse course, go back to zero, go back to QE, because even the smallest rate hike would prick this bubble, and that is exactly what happened. I think you're correct. I think the U.S. recession began at the end of last year. I think the government will ultimately admit that before the end of this year. They didn't admit we were in the Great Recession until we were almost a year into it. So I think that's the same thing. All the indicators that we see, or almost all of them, are flashing recession. We're getting so many indicators that we never see unless we're in a recession. I think we're also in a bear market in stocks, even if it's not officially a bear market because we're not down 20% yet. I think half the S&P 500 is down more than 25%. Earnings are collapsing. The financials are getting destroyed like I haven't seen since 2008. Retailers are getting obliterated. So this recovery, if it ever existed at all, is already over. And the last rate hike was probably the only rate hike. I think the Fed is going to be cutting rates this year, maybe going to negative rates. Yeah. We're going to be launching QE4. And so the whole narrative is blown up. And that's what's different between this gold rally and all the rallies before. People were still looking for tighter monetary policy. Now they're going to start to talk about easier policy. Is the Fed going to raise rates at all in 2016? Are they going to cut? Are they going to go negative? Are they going to bring back QE? I think the answer to all these questions is yes. But as people figure this out, I think this rally is going to intensify because people still haven't gotten their arms around this change of narrative. I think this is going to be the biggest up move yet that we've experienced in gold stocks, even including what happened from 2001 to 2008.
Yeah, you know, Peter, I completely agree if that is a long-term view. My hesitation or cynicism is only for whether this is it, because I see the eventuality of that. You know, I hate to name drop, but I'll have to name drop on this one. But at my New Orleans conference 2 conferences ago, I was talking with Alan Greenspan, who was one of our speakers, and he told me directly that there's no way the Federal Reserve was going to get out of its zero interest rate policy and quantitative easing without some type of a major market event. And I don't know whether he was talking about what we've been going through so far or something worse, but perhaps what we're going to see is the Fed, as you mentioned, going to negative interest rates, which is something you and I have both been talking about for a few months now, and what those implications are. The key is that even with 25%, fully 1/4 of the developed world living under a negative interest rate policy as we speak, the ramifications of these, the consequences, either intended or unintended, are really unknown. It's an incredible experiment.
Well, Brian, they're not really unknown. I mean, we know what happens when you print a bunch of money. I mean, this has happened in many countries over time.
Oh yeah, from that standpoint. But they've never charged you rent for your bank accounts before, or very rare.
Yeah, this is going from the sublime to the ridiculous. It's just going to mean that what's happened in the past is going to happen even bigger. Look, your skepticism is a consequence of what's happened in the market, and that's healthy for this bull market. But if you actually realize how cheap gold stocks still are, I mean, a lot of the major gold stocks are still cheaper than they were in 2000 when gold was under $300 an ounce. I mean, when gold went from 2001 to 2008, when gold prices tripled, gold stocks went up tenfold. Today, the price of gold is still 25% higher than it was at its peak in 2008, yet most gold stocks have surrendered their entire gain, not just some of their gain. They've surrendered it all, and they're cheaper than they were. The power of this move, you see, once people realize how wrong the narrative was, everybody expected the Fed to be going on a new tightening cycle. Everybody thought the Fed's balance sheet was going to shrink. It was all that false optimism about a phony U.S. recovery and about how successful the Federal Reserve's policies were. They were a disaster. The balance sheet is going to go, the Fed's balance sheet is now $4.5 trillion. This thing is going up to $10 trillion and beyond. There is no way out of this, right? Greenspan was right, but, I mean, it was earlier. I was saying when the Fed first did QE1 that they were checking into a monetary roach motel, that there was no way out from this. When they went down to zero, that was it. But everybody believed it was a success. And it was based on that false belief that they sold gold. And when they have to reverse those bets, the problem is the gold isn't there. If you look at all the institutions that crowded into the gold trade after QE1 and 2 in 2011 and 12, that drove the price of gold up to $1,900. They all bailed out because they believed that it was a false alarm, everything was great, the Fed solved the problem. When those institutional players want to get back into the gold trade, when they want to cover their shorts, when they want to go long because the Fed is launching QE4, and now they realize that there is no end to this. This is QE infinity. There is no way out. It is cheap money forever. When they want to get that gold back, it does not exist. It is vault in China. It is owned by central banks. The gold ETFs are not going to be able to replenish those supplies because the people who bought all the gold at $1,200 and $1,100 and $1,300, they're not going to sell it. That gold is not going to be on the market. So this is going to be a massive, massive rally. Even if this isn't it, right? It's going to come. But I think that this rally here is more credible than any of those rallies in that chart that you saw in the past.
Because of the fundamental background.
The fundamentals that have changed that didn't exist since then. I mean, now this is it. The game is over. The Fed can't pretend anymore. The numbers are awful. The market is collapsing. I mean, you haven't seen financials selling off like this, obliterating. First look at the European ones. Look at like Deutsche Bank or Credit Suisse, but look at what's happening at Bank of America, Citigroup, Morgan Stanley, Goldman Sachs. And then look at the retailers. I mean, one retailer after another is being taken out and shot. Just look on Friday, Restoration Hardware. That stock is down. It was over $100 a share in December. It's under 40 today. You know, you're talking about 70% in 2 months, and they're doing this one stock after another. Even Amazon had lousy numbers for the fourth quarter. All the retailers are blowing up. These are domestic demand stocks that are showing that the U.S. economy is under some severe stress, even with interest rates barely above zero.
You know, I'm glad Peter brought up the European banks too, because if you go back to the 2007-2009 crisis here, obviously it was our mortgage and our stuff that was going bad, and so the focus was on Lehman Brothers and Countrywide and all those institutions. But now you've got, Deutsche Bank. The stock that trades here in the U.S. is at its lowest ever. I mean, it's undercut the lows it had in the depths of the credit crisis. HSBC, another one, Standard Charter, all these big, huge European banks. I mean, their stock prices are in free fall. Their bonds are in free fall. Credit default swaps, basically betting against their debt. The same things that went off the charts high here in the U.S. when Lehman and AIG and everybody were blowing up. They're doing the same thing over in Europe now. That's the focus of the trouble. So this isn't just a U.S.-based problem. This isn't just U.S. monetary policy that's lost control. It's happening in greater degrees in Japan, in Europe, and so on, and that's having huge impacts in the market.
And one thing I want to point out too that's different is while we've had a bear market in gold in the U.S. for the past few years, we've had a stealth bull market in almost every other currency. I mean, we've almost made record highs in the Australian dollar price of gold, in the Canadian dollar price of gold. But look at what's happening in South Africa, record highs in the rand price of gold. We've had record highs in the Russian ruble price of gold. Look, we're almost at a 3-year high today in the British sterling price of gold. We're about to go over 900 pounds per ounce for gold, a 3-year high in Britain. So it's all of a sudden, gold's been going up in every currency but the dollar. Now it's going up in every currency, including the dollar. So you're really starting to see this. And even if you look at the price of gold in terms of other precious metals, look at silver, look at platinum. Gold is breaking out. This is monetary stress.
That's what happens when gold leads a cycle on the way up. When it leads silver, that's a sign, as you just said, of monetary stress.
And think about this. You've got people going to negative interest rates. Now, I mean, the knock against gold was always gold doesn't pay any interest. Well, neither do euros, neither do pounds, neither do yen, neither do dollars, neither do Swiss francs. But now all of a sudden, not only aren't those currencies not going to pay interest rates, they're going to charge you money to hold them. And they're talking about getting rid of cash. They want to get rid of the $100 bill or the 500 euro note or the 1,000 franc note. I mean, so there has never been a period in my lifetime where there were so many reasons for so many people to own gold that don't own it yet. So
risk if you don't.
Yes, and the amazing thing is that people haven't figured this out yet. But when they figure it out, just like with the subprime, and I remember we were short subprime mortgages, and there was a movie about that now, and they didn't have me in there, but we did it. And I remember when we were shorting subprime mortgages, this was a situation where the whole world believed one thing, and just a handful of people knew that it wasn't true. But when the big group of people that knew that believed in it, when they figured out what a few people knew, the whole market imploded in a matter of weeks, and that was it. And so when you have all these people now that are clueless and are own these fiat currencies and don't understand what's going on, but you have a small number of people who have figured it out and already own gold, when the huge masses of people all of a sudden figure that out too and say, you know what, I need to own some gold, even a small percentage. I want to take 5% of this enormous stockpile I have of currency, and I want to put that little teeny bit into gold. That's it. The price just goes ballistic because now you have all these buyers and no sellers.
That'll be like what the famous Doug Casey line, trying to put the contents of Hoover Dam through garden hose. Now, while we're on this, though, we have Mike's final chart up, and Mike, you'd mentioned the financials turning over. Of course, those are the stocks that were the key beneficiaries of this whole wealth effect of pumping up asset prices in the financial market through quantitative easing and the rest. But this chart is, I found, really fascinating, because what you've done is pinpoint where the credit market turns and what happens to stocks. Can you kind of elaborate on that a bit?
Yeah, sure. I mean, if our viewers think back to the previous chart where we kind of showed, okay, here's where the credit cycle had a negative turn from easy money to tight money, and here's where it turned back from tight money to easy money. The red ovals on those charts corresponded when you flipped that switch from easy to tight, and the green ovals on that one switched when you went from tight money to easy money again. Well, I kind of took those same time periods and marked them on a monthly chart of the Dow Industrials, and you can see clear as day that when the credit cycle turns in faith in the ability of companies and consumers to pay their debts back goes out the window, that's a huge negative signal for stocks. It's not a precise one-day timing period, but it can give you kind of a window within a few weeks or a few months of when you really either need to get short the stock market or get long the stock market. And we had the first major negative turn back at the peak of the dot-com bubble in 2000. We had the second major negative turn, kind of at the peak of the housing and mortgage bubble. And if you had just basically either got out of stocks or shorted the market, I mean, you saved or made yourself a small fortune. Now we see a similar topping pattern, technically speaking, in the broad averages. It's being confirmed by the credit market. And now when you bring up Peter's point about, well, what are people going to do? If you start seeing these major support levels start to break in the broad averages, which we're either already doing, depending on which index you're looking at, or very close to doing so, people are going to be looking to put their money somewhere to preserve it. And I think that the gold's an obvious choice in a market where bonds, high-risk bonds, aren't doing you any favors. I mean, the high-yield market had its worst year last year since the Great Recession. And if stocks are truly breaking these important support levels, which I believe they are, you've got to find an alternative. You've got to find an investment that's going to help preserve your wealth in this sort of third major negative phase for credit and for risk. And I think I think gold is tailor-made for that kind of environment.
One of the things, if we're accepting this premise that whether it's this rally or the next, but that gold has been carving out a long-term bottom here, and the next run up is going to be of the likes that we saw in the early 2000s or since 2009. It's going to be a lot of money made. And one of the things that we'll be talking about on this cruise, and frankly that we can't talk about in the major media, are specific ways to leverage these. We now have Brent Cook on the panel. Brent, can you hear me?
I can hear you fine. Can you hear me?
Yes, great. You're on. Finally solved the computer problems. But what we have here, Brent is, in my view, the best guy in the industry for analyzing junior mining and exploration and development stocks and finding ones that are almost that are good companies, good projects on their own merits, and therefore somewhat insulated from extraneous factors such as the broader market, because they do have good projects that can go into production eventually. But in a market like this are the ones that are really high-powered and leveraged to the move in the underlying metals. But Brent has some fundamental analysis as well that I find fascinating that we'll bring up right now. Brent, here's your peak gold chart. Can you kind of explain what we're talking about here?
I'd love to. I think I'm going to change the title of this. Peter's comment that the gold isn't there should be what we have on this chart. What I show on the left side is the gold discovery since about 1990 until 2013 in millions of ounces. And you can see clearly that we had a peak of discoveries in about 1995, and that's declined more or less ever since then and has gotten really low over the past few years. There's a lot of reasons we had the peak discoveries. Basically, most of the world opened up to exploration as geologists were able to go into new places like Burkina Faso, Argentina, etc., and walk up to deposits that were basically outcropping. That has changed, and what's changed is that we've, with Landsat imagery, etc., we've covered most of the Earth that we can see. So it's a lot more difficult to find these deposits now. Additionally, jurisdictional risk has come into play where a lot of places we could go, we can't go anymore. And it's gotten a lot more expensive as well, given that now to find an economic deposit rather than walking across the surface, we have to use esoteric geophysical methods and drilling in that. It's a lot tougher to find them. And I guess the last point I want to make on that is that if, on average, if for every, let me get my numbers right, for every 10 1 gram per ton deposits the Earth makes, it'll make one 2.5 gram deposit.
Mm-hmm.
So in our exploration efforts, we're drilling deep now, looking blind, if you will. We're still going to find 10 1 gram deposits for every one 2.5 gram deposit. But now at that depth, etc., it's only the 2.5 gram deposit that's going to work. So
Unless the gold price goes up substantially.
Yeah, I don't buy that.
Really?
I don't. Most deposits that don't work, that are marginal, uneconomic, stay that way. And so I think what we're seeing here in this peak production on the right side is that production peaked in 2014, which is about 10 or 20 years after the peak in discovery. So on average, it's taking from discovery to production 10 to 20 years to put these larger deposits into production. So I guess the final point on this slide is that we are not going to be able to ramp up production to meet the demand, even the current demand. In fact, we're finding on average, call it 40 million ounces a year. We're producing from mine production 90 million ounces a year. That 40 million ounce gap in there is not going away, and it's going to get worse. So as that plays out over this year and the coming years, the very few economic deposits that the companies we can identify, delineate, own, and sell are going to be worth a lot of money, because every 1 ounce a company produces, if they don't replace the ounce, they're going out of business. So the setup looks really, really encouraging to me.
Yeah, and to add a couple of points to that, from my experience, well, number one, what we've had about a 4.5-year bear market in gold. So what's happened during that time frame is that the majors have curtailed, if not, completely ceased exploration expenditures. So this decline in discovery is going to be even steeper because there's just not anything in the pipeline. From the other standpoint, one of the things that Peter had mentioned earlier, and he and I both mentioned this on a panel this weekend at another conference, was the fact that there's a flow of gold now for years going from west to east, and the vaults in the west are running dry. But what's happened in Asia, particularly China, is that demand and buying has exploded. According to the Shanghai Gold Exchange withdrawal numbers, which is a very accurate, in my view, a very accurate proxy for Chinese domestic gold demand, China consumed a record 2,650 tons of gold last year alone. Now, there's only about 3,000 tons produced in a given year, so you add China and India together, India with about 800 or 900 tons, then you're well into a deficit. You're taking above ground stocks of gold out. You're not only consuming all of the annual production, but you're going into a deficit situation. And what you're showing here is that we're actually at peak gold, so even production is going to start falling. So they've got to try and find the gold somewhere at some price. Now let's take a look at how people can take advantage of this. This is another great chart of yours showing the curve, a development curve, and exploration, when you should buy basically a junior developer or exploration stock.
Right. My focus is on the junior exploration companies, the guys that are out there acquiring ground, taking soil, rock samples, doing a bit of geology, very early stage stuff, because that's where really you get your biggest bang for your buck. If they make a discovery, it's not uncommon to see a company go from 10 cents to $10. It's got to be a legitimate discovery. And as I mentioned before, the odds of making a discovery are extremely low, like 1 in 1,000 to 1 in 10,000, depending on the size deposit we're talking about. But along that way from your early soil sampling and trenching to the drilling, as the data comes in and begins to look better, the share price rises. And just that rise in the share price, as you can see it running up the speculation side of that, that's people getting into the stock who believe that your company is onto a major discovery. The reality is that most of those apparent discoveries are going to turn out to be busts. As an analyst, I guess, a newsletter writer, my job here is to identify the ones that might work. But more importantly, if I know most of them are going to fail, I've got to identify the fatal flaw. That's what investors need to do, speculators do, is identify the fatal flaw before the rest of the market figures that out. So I guess what I'm saying in the long run is that there's a lot of money to be made on projects that are eventually busts.
Yeah.
Better yet, if you can actually hold on to a company that makes a discovery that is legitimate, brings it through to the drill definition and resource definition phase, and gets purchased by a major company, that is really where the big money is going to be made. In the previous chart, I think it was obvious that these major mining companies are producing twice as much as they're finding. So these legitimate deposits, as they come out, begin to look economic, are going to be in high demand by the major mining companies. So it's actually looking pretty positive out there.
And you know, Brent, one of the things that I think is different in this cycle is that we've had a very long bear market in gold and the mining stocks, yet as we exited the last bull market, a lot of these companies, these small exploration companies, had made discoveries and gotten cashed up. So even in this long bear market, a number of these companies were able to advance their projects, not as quickly and more prudently and conservatively. But what we've been left with now is that here, as the market is starting to take off again, there are a number of companies that have world-class resources identified, in some cases very advanced economics done on them, and yet they're selling for about the same price as the wildcat exploration companies were selling for, you know, in the top of the last cycle. So in one way you can look at this is that you don't really have to take on the exploration risk. You can take companies that have already solved that, just have already found something. Yet as the market takes off, they could easily go up 4 or 5 times just to reach their previous peaks or more, because they've even identified more gold, more silver, and established some firm economics in that. So there are a number of companies, I'd say between 6 and 10 out there that fit this this category, these characteristics. And you know, I'm outlining these in Gold Newsletter. I know you are in your newsletter as well. But that's a way that they can take advantage of this cycle a bit, and or have a quick takeout that may not be, you know, 4 times their current share price, may only be 50 to 100% of where their share.
What I think is the most encouraging thing from my perspective, though, is really 2 things. One, you know, the Fed is still pretending that everything is okay and that they're going to be raising rates again later this year. The question is how much and when. But even with that dynamic, gold is still rising. Gold and gold stocks are going up, even though the discussion is still about tighter monetary policy. So we haven't even flipped the switch yet to talking about looser monetary policy, from at least officially. So that's going to send gold into a whole new gear once that dynamic changes and the Fed starts talking about and then actually cuts rates and does more QE. I mean, this is going to be so much faster. And the other thing is, even you are skeptical, right? There's plenty of gold bugs that they've been burned so many times in the last few years that they're reluctant. And I can tell you, I'm in the gold business, right? I've got a gold company, Shift Gold. I sell gold through my offshore bank at Euro Pacific Bank. And business has picked up on this, but not nearly as much as it picked up on the previous rallies. So the people have been beaten up so much in the last few years that the gold bugs are like, I'm not going to bite yet. I don't really believe it. So that's what the last few years was meant to do: destroy confidence in the bulls and embolden the bears, who are all short. I still hear a lot of people saying, let's look for a rally to short. And in fact, at the end of last year on CNBC, everybody was short gold. Everyone was short gold. People that have probably never shorted anything were short gold. So
And long
this
banks.
has returned, and I'm still getting people, calling up to close their accounts with me. People are still skeptical. This is the biggest wall of worry that I've seen, despite the fact that all this stuff is going on. So I don't know what it's going to take to get people, even the gold bulls, the gold bugs, to get more bullish, because they're not. They're still worried.
Peter, in even saying that, somebody is buying. One of the interesting things that I've seen recently is that on days when there is absolutely no news that can be interpreted bullish of gold, you'll see gold pop $15 or $20, and without any support from the markets, any fundamental indications of any reason, and it just seems like it wants to go higher. It has
some of these stocks. Look, you could take a stock like Harmony Gold, right? A little South African miner that is at a 52-week high today, up another 7%, $3.22. That stock late last year was at 50 cents a share. So you're talking from 50 cents to $3. And and these are huge moves. I own a bunch of gold stocks. All the Wall Street firms, the only thing I've seen, Newmont recently downgraded to a sell, Newcrest downgraded to a sell, Yamana downgraded to a sell. The only thing the major brokerage firms are doing, they're watching these gold stocks double and triple, and all they're doing is going from hold to sell. They're not upgrading these stocks. The stocks that they have buys on are the ones that are getting killed.
And Peter, that brings up an idea, and one of the things, we're getting short on time, but one of the last points I want to make for this part of the webinar is the potential that we have lying ahead of us. That just the major gold stock indices, to get back to where they were in the last peak, they'd have to essentially quadruple or more. And that's the average stock. The average gold stock would have to quadruple. Now, when you go in,
I just mentioned Yamana, which was just, someone just put a sell on it, and that stock is, it's doubled since January. The low in January was $1.38. It's at $2.85, and I'm not just recommend. I'm just talking about it. That stock was $20 in December of 2012.
Yeah.
I mean, this stock still has a long way to go. It still has to double to get back to its low from the crash of 2008. And again, this is just one stock. There are so many just like it.
Mm-hmm. And one of the things we're going to do on this cruise is pinpoint specific opportunities, not just go over the fundamentals and the technicals that are driving the market, but also go through the specific stocks. And that's really one of the big benefits of it. I have a slide up here showing some of the things you get on this cruise. And 7 days in Alaska, the Crystal Cruise Line has been ranked the best in the world for, I think, the last 14 years running for mid-sized cruise lines. You'll have these 2 days at sea with very detailed, intimate presentations with our speakers, plus speaker-hosted dinners, lots of time to mingle and socialize, free wines and premium spirits. Even some of our speakers would be willing to buy a round at the bar when it's free. So, no names. I'm not mentioning any names here, Brett. But and the restaurants are fantastic. It really is the lap of luxury, and the information that you get is exceptional. I'm very, very excited about all the sites we'll visit and explore with all of you, all the attendees, the cruisers, and the speakers. So I want to really stress that the cabin block for this event is set to close very soon, so you'll need to respond very soon if you want to get on this cruise. And as you can see at the slide that's up right now, there's going to be a cruise ending symposium in Vancouver where we'll not only have Peter Schiff, Rick Rule, Brent, Mike, and myself, but also Eric Coffin and Gwen Preston and some presentations by some top-end companies, and maybe one or two other speakers that will be surprises as we come along. So I urge everybody to call today to register. You see the phone number up there, and there's also in the handouts some information that can be downloaded very easily through the GoToWebinar screen. I think we're about out of time here. Mark, did we have any questions from the crowd?
Let's see. We had
I saw two hands.
one or two came in here. Let me start with this. There's a comment here that said David Stockman's forecasting a $3 trillion collapse, which is to start the ball rolling for a super crash. He stated that it'll start in mid-March. Do you guys feel that that will happen around that time?
I don't think you can put that fine of a time frame on it. I don't dismiss the possibility of anything, but I don't know how David Stockman came to that conclusion. I think you have to look at the cycles and where we are, and not try to put that finer point on the timing. Anybody else have a comment on that?
Yeah, I'd jump in on it. This is Mike. I look at things like where junk bonds are trading, where some of the economic data, like that chart I showed about the ISM index, the manufacturing sector, where that is. You look at where some foreign markets are trading. You look at where some of these banks, are trading at 3, 4, and in the case of some of these European banks, multi-decade lows. And then you look at the Dow, at these levels, wherever we're at, 16,500, 17,000 in that general kind of range. And you say, why are the broad averages trading way up here when all of this other stuff, all of these other indicators are trading way down here? If you look at the chart, the difference between some of these indexes that track junk bonds or leveraged loans and spread levels and all of that, they're indicating that the market that should, and I put the word should in quotes, be trading at much lower levels. So if anything, I think, yeah, there's a big risk that stocks have a lot of room to play catch down to what other markets are already signaling. So that's one reason why I've been very cautious on the stock market since last summer, and I think so far that thesis has played out very nicely.
Yeah. So in general, I think what we're looking at is it doesn't look very beneficial for the stock market going forward, and what we're likely going to see is that kind of event that Alan Greenspan warned me about at some point in the future. But timing, I still think is you really can't cut it that finely. Is there another question, Mark?
Let's see. One attendee had a question. So are you suggesting to own gold or just invest in the appropriate mining stocks?
My point of view on that is really everything, and there's a number of ways that you can invest in the metals and the mining stocks to leverage the metals, but everybody, in my view, needs to have a core holding of bullion, and there are a number of ways to do that. You can actually find a free report on that at my website, goldnewsletter.com. It is free, so I'm not trying to sell you something, but there are a number of ways to do it. You need to have a core holding of precious metals though before you do anything else, and you have to look at that as you would fire insurance. You don't expect your home to catch on fire, but you want to have insurance just in case, and that really is the primary role that gold serves. But I would invest in mining stocks if you have the available income and you can take on the risk. This is a wonderful time to do so in top quality names, and whether it's through these speakers here or elsewhere, make sure you educate yourself before you get involved in the sector, though, because it is a bit complicated. Anybody else have anything else to add to that?
Yeah, I would just throw in again that the flows that we're seeing, that I'm seeing in general from my gold mutual fund, from just clients. I've got 15 to 20,000 retail accounts. I do a program at the Perth Mint. I'm a dealer for the Perth Mint at two of my companies, right, at Europe Pacific Capital and Europe Pacific Bank. We're dealers for the Perth Mint. I have a gold company that sells retail gold coins, right? We have lots of gold stocks. We have a lot of clients that have a lot of gold stocks, and I'm telling you that It's not like the phones are not ringing off the hook. It's still tough to keep people on board. I still have people calling me up wanting to sell their gold stocks, because they're still like, well, I'm down. They don't even realize how much they've gone up in the last month. They're still looking at their statements from the end of last year, and they're like, well, let me just get out. This is so early on. There's no buying. There's so much skepticism, and yet we're still seeing moves like this. I mean, look at today. I mean, gold stocks as a group are up 3.5% on the day. The Dow's down 70 points. I mean, the only green on my screen really are gold stocks. I mean, and they're all green across the board.
All right, for that moderation, I'd appreciate it. Thank you for joining us, Mike. You as well, and Peter as well.
Thank you.
Thank you,
so long,
gentlemen.
guys. Bon voyage.
Ciao.